Hi everyone, it's Evan here from the Trade Risk on Friday, February 17th with a weekend market recap video. We're going to cover all of the major markets, the current market environment, some sector analysis, and then finish off the video looking at some of those popular individual high beta names. We haven't taken a look at some of those in quite a while. So let's get into the video here. We've got a lot to cover. S&P 500 finished up on the day Friday, up 0.16%, and we finished the week near the highs of the week. So let's look at that weekly chart first. Take a look here. You can see tremendous amount of strength, up 1.5% on the week, all things considered, and some strong follow through to last week's session at last week's candle. On the weekly chart, you can see we are getting a little bit extended from that fast 8-period EMA. Doesn't tend to like to stay too extended on this time frame before it wants to consolidate or mean revert. And you can see it's pushing those edges right now, but tremendous amount of strength, no doubt about it, all-time highs. There's certainly a lot to like there on that longer term time frame. Now, if we pull our attention back to the daily chart, our last video update was right here on Wednesday, and on Wednesday we had 7 days higher in a row here in the S&P 500. We were extremely frothy, very overbought, and since then we've had now 2 days of digestion. Now, these days are very minor. They're it's kind of funny to think that they are full digestion days, and it's even funnier to think that perhaps after these 2 days of pause of not making new all-time highs, maybe it's time that we can go back off to the races into next week. It sounds funny because this is just still such a tremendous run that we're seeing. But this is a tremendously strong market. We have yet to see any real selling pressure hit the tape. Even intraday, you don't see many, minus 1,000 ticks. You're seeing plenty of weakness get bought up, especially over these past 2 days. So there's a lot to like on the long side. The other point I would make here is you need to be careful looking solely at the S&P 500. So a day like today, for example, we finished up 0.16%. Everything looks good. This looks like tremendous strength, and it has been, but I want to point your attention to something like the energy sector, which was actually down over 0.5% today. And in fact, energy has been in a downtrend since December. It's actually off 8.5% from these highs here in December. So you really have this little stealth bear market going on in the energy sector. Meanwhile, the S&P 500 is completely ignoring it. You would have no idea that that was going on if you were solely looking at the SPY ETF every day. So just keep that in mind. This market is masterful at rotation. You're basically seeing if one sector takes a break or we get a 2 or 3 day pullback in one particular sector, money finds its way into something else, and the S&P 500 finishes off with days like this. It looks like every stock is going up every day, but you really, depending on where you're positioned, are feeling that strength or weakness in a much more concentrated fashion. And I think you know what I'm talking about if you've been in some of those sectors that do get that little quick wave of selling or at least strength over these past few days. So a little bit of a rant there, but I think that's very important to point out here in this broad picture. Final point, third, markets are closed on Monday. We got a 3-day weekend. Generally like to see, generally either get a bid in volatility. Maybe that happened over the past couple of days. We did see the VIX rise quite a bit, and we were already positioned for it. Or there's some softness in the market going into the long weekend. We didn't see that at all, right? We saw just continued strength. Like I say, weakness was bid up all throughout today. So lots to like in this market. I think you have to be aware that we are in a markup phase. We're in a high momentum phase, and overbought can stay overbought, and this market's proving it to us right now. And if you are on the camp that says, look, the S&P 500 is way too stretched up here, it can't go any higher, it should pull back, look no further than the Qs, because the Qs have been running for 2 to 3 times as long as the S&P 500 already, even more stretched, and they continue to just levitate higher every single day. So before you get too aggressive or firm in your stance on the S&P 500, just make sure you look at some of those other indices, because they're arguably even more overbought and continuing in the same path. So that's sort of my thoughts here on the S&P 500. Look, I would love a pullback. I think everybody wants one. That's probably why it's not going to happen, or not going to come too easy. We could easily pull back to 230 and still be very healthy and structurally in a nice strong uptrend still. Maybe it happens, but for now there just aren't any signs of it. And who knows, that can change very quickly next week. We'll have to see what happens. Now, I think to pay attention to that and to try and find those clues, like I've put out in some recent videos, is paying attention to the IWM, because I do think this is the interesting index to pay attention to right now, because it hasn't really participated in a very strong fashion here over the past couple of weeks. IWM is the laggard index. It's up only about 3% on the year, which is still great, but nothing compared to the 5.25% or 9 or 10% of the NASDAQ. So it is the laggard. It is emerging. It broke out this Monday above recent resistance here. It's starting to make new all-time highs, but you can see it hasn't really gotten going yet. 138, this is a very important level. I also think that the IWM is important because this is should be, or certainly will be, one of the leaders if it can start to emerge here and leg higher. I think back to that rotational, hot potato game that the market's really good at. I think this is your leadership sector next week if we continue to march higher. So, keep an eye on it. I think that, again, the levels are tight here. We got long this today, the IWM, so we are positioned here long. I think the risk reward sets up nicely. A tight stop loss is all you really need here to potentially capture a nice sort of emerging and continued trend higher. I think that looks pretty attractive. Again, we'll have to see how things shake out on Tuesday. It has been the laggard, so if it does fall back into this old range, that could certainly start to derail the S&P 500 rally, and maybe that's the excuse that the market needs to start to pull back. So keep an eye on the IWM. I think that's important. And the NASDAQ 100, living in its own world, right, just continues to march higher here relentlessly, floating above the 8-period EMA, tremendous strength. When will it stop? Nobody knows, but just continues to work. And even in some of the individual names that make up a large component of this, some of them still look pretty good. I mean, I know Apple's been doing a lot of this heavy lifting here, but there's plenty others that look pretty good. So we'll look at that in just a little bit. So that is the stance there on the major averages. Let's take a look at some of these other markets. TLT continues to move sideways here, catching a bit into the end of the week. It's still in the same range that we've talked about. Nothing is new between 118 and 123. If you want to play those ranges, that makes sense. That works. But really, you need a breakout of one of those to sort of move out of this consolidation pattern that it's now been in for about 2.5 months or so. USO. Again, consolidating, something I'm paying a lot of attention to. This is also going to be something that can really start to influence the market. XLE, of course, is nosediving lower as USO continues to move sideways. We'll have to see, how this ends up resolving and what kind of spillover effect this has on the market. But lots of overlapping price action. You're seeing ranges really contract here. Look for a breakout over the next couple of weeks. It's going to be interesting to see. I think the levels are pretty clear, so hopefully we'll be on top of that when it happens. UNG just continues to get rolled over. Started at the beginning of the year, and it continues to be in sort of a bear mode here. If you project this move that started basically the year, this down leg with this little up move, and then another, this down move down here, you get to around 670. Maybe that's where it's beelining to. I don't know. I'm not involved in it, not interested in it at this point at all. So something to think about if you're playing around in that market. GLD continues to just move still in the short-term trend higher. It's finding some resistance here at these prior highs, and it's got some support down here at 116, so pay attention to those levels. SLV, not much else to say either, still in the short-term uptrend, 8 and 20 period, serving as a pretty good guide for the silver market right now. So that covers the major markets. Let's take a look at some of the individual sectors. I mean, XLK, it's just the chart kind of speaks for itself here at how There's just zero selling pressure here at all. It just continues to float higher every single day. So XLK looks tremendously strong. If we take a look at XLF, financial sector. So again, started the week off hot. This is really what fueled us at the beginning of the week, as a lot of those bank stocks just moved higher. They saw a little bit of digestion Wednesday, Thursday, and then Friday did close at the highs there. So again, a little bit of a pause. Maybe that's the only pause you're going to get before this strong trend continues higher. XLF, though, looks very good. XLE, we already talked about. That's a downside candidate, 8% off those highs. XLB also notably underperforming a little bit, just again playing the relative game here of sectors. You could see potentially putting in a lower high, so pay attention to that, but materials lagging just a little bit here as well. So that covers the sectors. Let's take a look at some of those stocks, individual names. Facebook is one that is a little interesting here. It hasn't participated much in this, in this huge moves that we saw in the Qs, but it is still hanging out near highs. It's had a remarkable run since the beginning of this year, so it deserves a little bit of a rest, but something that you shouldn't forget about for too long. I think 135 is a pretty important level for it. You can see it's still just taking its time around this 8-period EMA, but if we can start to get some life in here, we'll very quickly be back at all-time highs. So something worth paying attention to. It's a candidate that again has moved sideways that can start to pick up the slack if it wants to start to emerge. Amazon is trying to emerge to all-time highs. I think it barely tagged it intraday to a new all-time high today. If not, it was really close. And actually, it did make a new closing high. So new all-time closing high today in Amazon. Let's see, 845.07. Yeah, so new all-time closing high here in Amazon. And you can see, you get a little bit of a pattern here. Maybe you got to squint your eyes if you want to look at it. But if you kind of do something like this, however you want to draw your lines, but I think you get the point here. As it starts to really break out, move to all-time highs, I think you could get a nice, a nice continued rally here, and one that has a reasonable measured move target that could really help power the market higher too if that one wants to get going. So pay attention to Amazon. Alibaba, this one a little bit weak here recently, but still one that I'm paying attention to. It's still holding on to the 20 period, so it's doing the work just barely necessary that it needs to. But this is a critical level here, this $100 nice round number. And you can see the highs here from about 104 are still in play. So it's just moving sideways in this uptrend. Let's see if it can continue or if there's some kind of rollover that's about to happen here. So Alibaba looks pretty interesting. And then finally, Twitter. I want to talk about this one real quick because I put out a post on this, I think, last week, covering the $16.25 level, more or less. It's above that. So if we go to the weekly time frame, take a look here. There's two very important areas, 1630, 1550. Actually, let's just go back to the daily. It might be easier to see. So the 1630, this has been multi-month lows. I think this was kind of what the post I wrote about talked about, basically saying if you wanted to be a bull, you could be optimistic in Twitter, barely so, but optimistic if we were back above 1630 and holding it, as those were the lows here from the past 6 or 7 months. 1550 was a prior support level back in early 2016, a couple of times back then, and that's exactly where the market held just a few days ago. So back to the weekly time frame, you can see still got damage, but Twitter is barely holding on, had an impressive week, 6.7% higher, so it is recovering some of those earnings week weakness, and if it can continue to hold above $16 or so, maybe tactically you have something that can eventually trade higher. Weekly charts still, kind of bearishly aligned here as far as momentum goes. It's not a momentum play, but I know there's a lot of eyes on Twitter. So for those of you looking to either dip buy or get involved early or start a position, reasonable above $16 the way I see it. So we'll end the video there. I hope this video helps. Hope you guys have a great long 3-day weekend. Thank you for watching. As always, I hope to talk to you again soon.